Hey friends, Lucian here with the Bullish Bears team. This video is going to be about the most popular swing trading indicators. So indicators that are very helpful to determine major support and resistance levels when you're swing trading. Now, while they're helpful, they could also be overwhelming if you use too many indicators on your charts. So there's a lot of new traders that come into the industry and they load up their charts with indicators, or they search for the holy grail of swing indicators that are going to work perfectly. The fact of the matter is there are no perfect indicators. Nothing is going to tell you what to do 100% of the time, because again, even the most successful traders in the world, they still fail 30 to 40% of the time. They just make sure they have proper risk management strategies so that their gains outweigh their losses. So again, there are several indicators that are very helpful to use. Another thing that's very important to remember is that most indicators are lagging indicators, so they're delayed. They're not real time. So even the delayed ones can work to some degree, but again, it's important to realize that none of them are foolproof. So while there are no foolproof indicators, the best indicator overall to use are candlesticks and understanding candlesticks patterns. And the reason for this is that it's real-time price action. And this price action is formed by the battle between the bulls and the bears. So anytime buyers and sellers come into the market or trade a stock, they form candlesticks, and candlesticks form patterns, and patterns show very important support and resistance levels. This shows where your potential entries and exits going into every single trade. All the other indicators that are out there basically come after, or they're lagging indicators that are based off of price action, which is candlesticks. Now, I wish there was a magic solution and make the process to become quick and easy, but it's not. Candlesticks take time to learn. Learning the most popular patterns is going to take looking at hundreds, if not thousands, of charts. And then the more charts you look at, the more familiar they become. So to make the process easier, we do have a free candlesticks ebook and custom-made wallpaper backgrounds. You can download them under our courses section. So again, these are very handy resources to help you learn the most popular candlestick patterns. Now here's an example of one of our custom-made wallpaper backgrounds. This is on bullish patterns. So we have most popular bullish patterns, bearish patterns, as well as reversal candlesticks. So I encourage you to print these out, put them up on your computer, let these patterns kind of seep into your subconscious. Again, they're not foolproof, right? Candlestick patterns will still fail many times, but it's still important to understand these patterns and how they work, because they're going to show you the entries and exit areas of when you enter into a stock. Volume is another important indicator to have on charts. So whenever traders around the world buy and sell shares of a stock, this creates volume. Now, volume is important on all time frames, but with swing trading, it's especially important with the hourly, daily, weekly, and monthly charts. If you're more of a shorter term swing trader, a few days, a week or two out, you're probably going to be focusing more on the 1 hour and daily charts. If you're going out several weeks or months, then you're going to pay attention probably more to the weekly and monthly charts. So the higher the volume, the higher the liquidity of stocks. You're not going to typically have as much liquidity issues with larger cap stocks. The liquidity issue comes into place with more of those small cap or penny stocks if you're looking to swing trade those. Volume also confirms potential breakouts and breakdowns. Again, it's not foolproof, but when you see those high volume bar spikes, both bullish and bearish, it can confirm those potential breakout, breakdown, or reversal areas. So here's an example of an hourly chart on Apple. If you see those bigger volume spikes, you'll see those kind of how it shows or confirms those breakout and breakdown areas. Doesn't always happen this way. Just because there's a lot of big volume bars doesn't always mean a potential reversal in either direction. But when it happens, many times those breakouts and breakdowns happen right at those spike levels. And here's a chart, or a daily chart of Apple. Again, pay attention to those little bit of bigger volume spikes, and you'll see, again, those breakout areas. Look at the bearish ones, and you can see, again, those volume breakouts and breakdowns happen many a times, or price will happen right near those bigger breakout or breakdown volume spike levels. So pay attention to those bigger volume, bigger spikes in volume, because then again, many a times you'll see those bigger candlesticks or reversals take place. Moving average lines are also very popular. There are two types. There's exponential moving average lines, otherwise known as EMAs, and also simple moving average lines, otherwise known as SMAs. They show very important support and resistance levels on charts. So many times you'll see price action gravitates back to those levels. That's where you'll see reversals happen many times when price gets further away from those levels that might want to pull back, or as price pulls back to those levels and hits those moving average lines, many times you'll see reversals. Now, EMAs are more of the quicker moving average lines. They react to quicker price changes. SMAs are more of the delayed. They're really, when you see some of these very important simple moving average levels, you'll see price action on longer terms, especially for swing trading. They're very, important to be aware of these levels, because this is where, again, many times those reversal areas will take place. They become very, very important support and resistance levels. So here's an example of some moving average lines that I have on my chart here. You'll see to the left there under the bullish bears writing the levels that I have for moving average lines. So you'll see I have the 9 and 20 EMA, as well as the 50, 100, and 200 SMA, simple moving average lines. So those are real popular ones. So the 50, 200, and 100 are really popular simple moving average lines, and the 9 and the 20 are popular exponential moving average lines. Also real popular is the 13 EMA. So you could either use the 9 and the 20 together or the 13 EMA by itself. So these are very popular moving average lines. And as you can see, as price kind of overextends one way or the other, you'll see price naturally kind of gravitates back with a lot of, especially with the larger cap stocks. Penny stocks have a mind of their own. They can pump and dump and get wicked overextended. So when they pull back, they typically pull back harder. It doesn't mean, large caps won't do that as well. You'll see the more overextended they get, the more they naturally gravitate back to those levels. So while staying on the moving average lines, another thing to be paying attention to is watching for crossovers on moving average lines, because many of times, when you see these crossovers, they show important trend reversals. So here's a daily chart of Apple. You'll see where you have those crossovers happen. That's of the 9 and the 20. That shows you some short-term reversals. So if you're looking at bigger overall, like longer term trends, and then you can zoom in and see some of these smaller, shorter term trend reversals, you can see when those crossovers happen, you'll see at first, a lot of times it'll get overextended, it'll push back to those levels, and then you see those crossovers happen, and you can see, reversals will take place on both bullish and bearish crossovers. So pay attention, those crossovers will happen. Many times you could let the crossovers happen, let price action break out, watch for the pullback to happen to confirm, and then you can ride the trend up. And then the same thing with, the reversals on the way down. When price comes down, when it fails those levels, many times it gravitates back up. You'll get that crossover and it'll continue going down. So just pay attention to those crossover areas. They're very, very important. Again, they're lagging, so sometimes you're late to the punch when this happens, but they're very important to put together in that bigger overall picture when determining support and resistance levels. RSI, or Relative Strength Index, is another popular indicator. It is a lagging indicator, but it's a nice indicator because it shows those overbought and oversold levels. So stocks are like rubber bands. They naturally want to snap back, or you'll hear the term pullback, to support and resistance levels the more overbought or oversold that they get. So this can happen over time, or it can happen very quickly. So RSI is an indicator that you can add onto your chart. Now, Bollinger Bands is also popular. It's basically like an RSI. Bollinger Bands is more of a visual on the chart, on the charts with candlesticks itself, whereas RSI is a separate indicator to add. So here's a chart of Apple, a weekly chart. You can see that indicator RSI that I have on the bottom there, and I highlighted the overbought and oversold levels, and then I highlighted price action above in the chart, and you'll see many times when price gets overbought it pulls back down to support levels many times at those moving average lines. And then when it gets oversold, you can see where it got oversold there, it bounced off that 200 simple moving average line, and then it moved back up, right? So RSI is just very helpful when you see those overbought and oversold areas. Watch for price action to naturally want to pull back to those moving average lines and those equilibrium levels. Fibonacci is also very popular. You know, the Fibonacci retracements are basically a common form of technical analysis that can be used to determine how deep a pullback or a retracement could be. So it's used as a determination of support and resistance levels, and it can be used on multiple time frames. So you'll see here those black lines that I have on the chart. You're just connecting the peaks and the valleys, so the high on the chart to the low, and then look at those, important, percentage levels, because many times you'll see price, obeys those support and resistance levels. So like when it holds, if you're looking for support to hold, you want to see those important levels hold. When you're looking for price to reverse and it goes up, those then become resistance levels. So if you become bullish on a stock, you want to see the price move up and continue above. So again, it's not foolproof. No indicator is foolproof, but these are some of the most popular ones to determine support and resistance. And support and resistance is absolutely everything in trading, because again, support and resistance is formed by price action or candlesticks. And once you learn candlesticks and those patterns, that's what's going to show you those important areas on where to potentially buy and where to potentially sell. This stuff takes time to learn, but if you just really kind of put the time and effort in, study candlesticks, study price action, learn how to manage your risk, that's going to be the way to help you to become a profitable swing trader. So hopefully this video helped you, and I will see you in our community. Enjoy.